Welcome back to the CryptoInvestar Podcast. My name is Daniel Leinhardt and I'm with Mr. Reeves Knyght. I always get him once in a week to discuss about tokenization, about RAS, and everything surrounding crypto. Hi, welcome back on the podcast.
Thanks, Daniel. Nice to be back.
I've been watching you closely this week, and you've been talking about how Ethereum will be the chain that will become the base layer for institutional use, and Swift using Ethereum with ZK APIs, and that it will be hard to dislodge. I read that comment on LinkedIn.
Yes.
What did you mean exactly? What is that special thing about Ethereum?
Oh, I think whether you talk about anything to do with crypto and anything to do with tokens, but crypto generally, there will always be, and Web3, there's always going to be a discussion about the blockchain and then which chain is going to be important or is the best for what you're doing. And there is a lot of posts about that on LinkedIn, and there's a lot of opinions. And many, tokens actually are minted by companies that are looking to finance and raise money to start a new chain, as an example. There's been quite a few, and they all claim to solve a problem or have features that will make adoption of crypto and tokenization and provide the benefits of crypto and tokenization to more people for wider adoption. And I think it's an interesting area because the first thing is, if you look at one of the original blockchain currencies, and that would be Bitcoin, it's old now. It's 20 years old or something nearly. And does it really have a problem? Does it need to be fixed? Mm-hmm. And arguably, had it been started today, maybe it would be a bit better. But really, it hasn't had many problems in the scheme of things. It hasn't been hacked. That may change with quantum computing, but anyway, right now it hasn't been hacked. It's not slow. It's still transferable. It meets most of its original goals. So then the question I always entertain is, so how much better can blockchain be? And so of the leading 10 or so chains, Ethereum is one of them, and Solana is certainly another strong contender, and probably a little bit more active right now.
Yeah.
But you have to think there's kind of two views on this. What will drive the greatest adoption of blockchain? And really what you think about is, if you're a regular crypto user, or you have some crypto in your wallet, or you have some tokens in your wallet, or anything like that, do you really think about or want to think about which blockchain your crypto is on, or which blockchain your tokens are on? Or do you just want to buy and sell your crypto and tokens? It's like, you don't, with regular fiat money, you don't think, does my bank use Swift, or does it use SEPA, or does it use some other messaging system to transfer my funds? You just want to know when you do a transaction, it happens. And
I think it's about services rather than understanding the technology behind it. It's about how you understand and love the services they provide.
Correct. And so when people start talking about which blockchain is better or which one's going to be the leading one, the one that's going to lead is going to be the one that's used by the most financial institutions, because they're the biggest users, really. They transfer the most money. So then you start thinking, which chain do most financial institutions use? Now, the clearest indicator I have is that different institutions have tried different chains, but what's one of the most fundamental IT systems in banking that's been going for the last 50 plus years is Swift. And Swift is used by most banks. And if Swift decides to experiment with a chain or align itself with a chain, that means it's going to have a lot of institutional traction and be used. It's going to start being used by more and more banks if Swift starts saying, we're going to be doing everything on Ethereum, as an example. And at the moment, Swift is doing most of its pilot work with Ethereum. So I think that's doesn't mean they'll stick with it necessarily, but they probably will. And when we talk about zero knowledge proofs, or ZKPs, the reason it's Ethereum with zero knowledge proofs is one of the, when people talk about why blockchain is good, the whole point is that it's a record of every transaction and that you can't be changed. So it's very secure. And that's great. But do you really want that transparency of every record being visible, meaning that someone can see every transaction you've done or I've done or anyone's done? Probably not. Now, many banks say their problem with adopting blockchain is they don't want their competitors to see what money they're moving and how much. Maybe it's because of trading, or maybe it's because of like how they're moving the balance sheet. But for whatever reason, they don't want that to be that transparent. And so these zero knowledge proofs are a mathematical way for the blockchain to recognize an approved transaction or an approved transfer, but without making it visible, is the simplest way of putting it.
Okay.
And
can you elaborate more about zero knowledge proofs? It's a new term to me.
Okay, well, to try and, without getting technical, the whole point is how does a transfer, or how does information move? How does a transaction get recorded and verified on blockchain? And part of that verification is a code is generated, and that code is transmitted to between different computers or nodes in that respect, and they have a signal, and like that chain of letters and numbers, is expected on both sides, and when it's verified, that's a verified transaction. But usually that is visible, and so that wallet entry, that code which represents a wallet entry or a transaction, is visible to everybody, and it will show how much was transferred and where it was transferred to which wallet. It's completely transparent, and that's great in theory. In terms of that was always what the degens, who were early crypto bros, were big on, and that's what they said about Bitcoin as well. Every transaction with Bitcoin is visible. It is. You know which wallets it went to. You do. The only thing is, with Bitcoin wallets, some were established when it was possible to be anonymous. So there are some anonymous holders. That's harder these days, and most wallets are not anonymous. And so you may not want that full transparency of every transaction you do. And banks certainly don't want that. And neither do other financial institutions, and neither do brokers and traders. No one wants that level of transparency. They may like the security and the speed of the transaction, but they don't want that transparency level. So zero knowledge proofs are a mathematical, set of algorithms developed that allows the blockchain communication to communicate that a transaction is happening and happened, and that it's correct, but without showing where it went and how much and the details of it. So it shows it shows the verification happened, but not the details of the verification.
Really, are people really interested in that kind of a system?
I don't think the
Because
average person is. I don't think most people are. But when institutions are talking about whether they adopt a technology, they certainly are interested. And when people talk about which chain, the reason people talk about which chain is going to be adopted is, see, if you believe it's Ethereum, you may buy some Ethereum coins or Ethereum tokens. Or you may, if you think it's going to be Solana, you may decide to buy Solana coins, because the value of that chain will go up if it's more widely used. So the real reason most people even pay any attention to which chain is going to be the dominant chain is that they want to invest in that chain, because they think that it'll be worth more, is the short thing. So I think that's the only reason people really talk about which chain is going to be dominant.
Which means that for institutions to invest or use largely a certain blockchain, it is not going to be how transparent it is. Basically, institutions would love less transparent blockchains to keep their data to themselves.
Look, there is there's probably more, but I know of one definitely, a blockchain that is completely private, as an example, and that's called Monero. You may or may not have heard of it. The Monero is completely private, but again, completely private may not necessarily be the best for an institution either. And also Monero is very small, so I don't see it featuring much. In all the big trials, whether it's with Canton Network or whether it's with the USDTCC or whether it's with other sovereign bonds, I think Ethereum's getting the most exposure. Now, the reality is, actually, financial institutions want to be multi-chain. They want to be able to use their products across all chains, because that's the point. But what they will do is probably settle on one chain as their base, or starting point, or where everything originates from. And especially when you're issuing not just payments, but when you're issuing digital assets, you may want to do it on one chain primarily to start with. But whether it's Chainlink or whether it's Canton, there's always going to be other applications that will make multi-chain access more efficient, rather than burning and minting tokens, or making the process more secure across when you go crossing chains. So there's always going to be, I think, a main chain for each financial institution to operate on, but they always want to be multi-chain in the end.
So for now, Ethereum stands number one for institutions for now.
In my view, I mean, I don't have statistics on that, but from, again, I've spent a long time in banking, and when I see financial institutions, like particularly the SWIFT network, using Ethereum, that makes Ethereum a very strong contender for getting widespread financial adoption.
Yeah, you've just said spending more years in financial banking. You said that in your early years, you worked in structured finance, but still people didn't understand what you did for a living. And you also said that you did some transactions, including securitizing assets and their cash flows. These days, you are working on tokenization. How are you relating today's tokenization and what you used to do previously for a living? Maybe you can take us back in the days.
Well, so here's the reality. structured finance has always, has been around a long time, and it's a part of investment banking that traditionally was considered, honestly, quite boring, because it involved, as an example, a bank may have a lot of mortgages on its balance sheet, and to renew that capital, it would put all those mortgages into, I'm simplifying this here, but it would put all those mortgages into a special purpose vehicle and sell shares in that special purpose vehicle to other institutions, and all the mortgage payments that people would make would go into that special purpose vehicle and then get paid out to every shareholder. And really, that's exactly what tokenization is. So the reality is that tokenization is just a digital version of what's been happening with assets for years, decades.
Yes.
I was doing this 25 years ago, and it was a established area when I started. I mean, it wasn't new when I started. It was a very established area. It's just that in those days, it was considered a boring product, not very exciting. Mergers and acquisitions was the exciting part of investment banking, but structured finance wasn't. It became, I think most people only even heard of structured finance as a product area when Enron went bankrupt. And if you look up on Google or ask ChatGPT about Enron, there was a movie about Enron called The Smartest Guys in the Room, and it showed like how Enron made a lot of money and then completely went bankrupt. It was the biggest corporate failure in American history. That's why it's a movie. And it was all because of their structured finance department. And frankly, it was structured finance products that, in a way, caused the GFC in 2008 as well. So while it may have been a boring area for many people, and most people hadn't heard of it until in the 2000s when Enron went, in 2001 when Enron went bankrupt, it was the biggest corporate failure in US history. And then again, people heard about it when, during the global financial crisis in 2008, because one of the structured finance products that caused the problem were these MBS or mortgage-backed securities that were made up of some very, very, very poor mortgages, and famously, included ninja mortgages. That you may have heard the term. And that was ninja. Ninja stood for no income, no job applicant. So someone who applied for a mortgage had no income and no job, and they applied for a mortgage. And surprisingly, the bank gave them a mortgage.
And how would they pay? How would they make the payments?
Well, the problem is there were problems with the payments. What a surprise. If you don't have a job and you don't have an income, not declarable. So a lot of, it's a joke, but like the people called, no income, no job applicants. Technically, that's true. What it meant was they didn't have a documented income. They didn't have a documented job. Now, usual applicants for those were people who were working for themselves for cash on an informal basis. They weren't paying tax. They didn't have a tax return. They were self-employed. They worked for cash doing whatever jobs it may have been. Maybe it was a taxi driver. Maybe it was a delivery driver. Maybe it was an Uber driver. But they weren't declaring the work, is the usual. And as a result, maybe they were earning some money. It's not like they really didn't have an income, but they had no provable income because it was all in cash, as an example. But the bank got around that by saying, well, you sign this piece of paper called an affidavit, and you sign this affidavit and say that you can afford the mortgage, even though you have no income to show. And you sign the paper saying, I have an income even though I don't have a job. So it's you self-certifying that you can afford the mortgage. And then they would give it to you. And the interest rates were, of course, higher because it was a higher risk product for the bank. But they still gave the mortgage. Now, when times were good and those people still had cash jobs and they were still okay, when the economy tightened up and those jobs, there wasn't as much demand, or they didn't have, they lost their income, or their income declined, they didn't make the payments. And so many of those mortgages defaulted. And then what that meant was that those securities that were sold to other banks and other financial institutions and insurance companies and all these companies that bought these financial products, these MBS products, they weren't getting their payments. So everyone's not getting their money. And that caused a lot of problems, especially for the rating agencies at the time rated those products as very secure. They didn't say they were very risky. And so they weren't really getting paid what they were worth for risk. And a lot of companies bought them that probably shouldn't. So, it caused the global financial crisis. But the principles behind those products, the way they're put together, the legal basis for them, are no different current modern tokens. And tokens are all, popular and big thing at the moment. But all they are is, instead of having a physical share certificate in the special purpose vehicle that holds the asset, you have a digital token. And that's it. That's the difference. And yes, because it's digital, you can do, in theory, it can be programmable. And in theory, they could be transferred without permission, or it's called permissionless trading. And in theory, they can do a lot of things because they are programmable pieces of technology. But the reality is the laws don't allow a lot of that to happen. If that token is classed as a security, which most investment tokens that give you rental income or dividend returns from shares or interest from debt, any kind of financial return, are generally security tokens. And then they get restrictions on how they're traded, who can buy them, blah, blah, and et cetera. So as a result of that, the reality is that the current digital token phrase, to someone like me, is more of the same thing I've been doing for 25 years. It's just a digital version of it. But for people who are not in my industry, it's a new product.
Yeah, like to me, who has not been in structured finance and banking, I'm seeing a whole new technology, a whole new concept coming to crypto and to the world.
And here's the thing, many people in the tokenization space have no finance background and no legal background. And they're looking at this as new crypto people, and they don't see the realities behind the product because they've never had the understanding of the product, how the product works. But how the product works and why it works is actually not related to the technology. It's the legal and regulation basis behind the product. The technology part is the easy part, but it only works because of the legal system behind it and the contractual system behind it and the regulatory system behind it. And that's based on securities law and securitization products that have been around a long time. So for someone like me, tokenization, I enjoy the space because there's excitement and it's new to a lot of people.
Yeah.
So I like talking about it, and I like the fact that people are excited to talk about it. But the reality is it's not really a new product. It's just a digital version of a very established financial product.
Yeah, I was reading one of your documents, and you also said that the boring reality is that tokenization for now and for foreseeable next few years, it is just an updated digital version of what you did in your career previously.
Correct.
You continued and said, traditional MBS and ABS, securitization transactions are the basis for the tokenization transactions.
Correct. And actually taking it one step further, tokenization as a product is new right now, and it's going to, if you read a lot of financial institutions, I think they said now by the end of this year, there's supposed to be 16 trillion should be on chain by the end of this year. And it's a big jump from last year. And that's true, but it's still not big numbers compared to world finance. But what's happening, tokenization will have a place in the world for a few years, but it's a limited life product. And I say that because once financial assets are issued on chain, there won't be a need for a token. So as an example, a couple of weeks ago, the Bank of Japan just finished a trial or a pilot where, and I think it was a Standard Chartered Bank, where they issued and sold and traded a Japanese sovereign bond on chain. Now, what that means is you don't need to have a token is a digital representation of an off-chain asset.
Yes.
But if the asset is issued on chain and it's crypto native, then you don't need the token. So if, as an example, if that bond was issued on chain, then you don't need a token. Now, if, as an example, US Treasuries were issued on chain, then BlackRock's BUIDL token wouldn't be required because it's the item's already on chain. If the securities laws changed and allowed company shares to be issued on chain directly, then there would be no need for tokens that to be issued to buy the shares, because they'd already be on chain. So tokenization has a lifespan that will end when the regulations in the world align and allow financial instruments to be issued directly on the blockchain. Now, that will take a while, to be honest. That will take a while. Maybe 5 years, maybe 7 years.
I was going to say something like 30 years.
No, it won't take that long. Because, as an example, Japan did their pilot of a sovereign bond a month ago. Earlier this year, Canada did the same thing, maybe 2 or 3 months ago, but it was earlier this year. The UK government has just, last month, I think, appointed HSBC and Orion to run a sovereign bond pilot program on chain here for the UK government. So that's Japan, Canada, and the UK doing that already. And if once they run the trial, that's pretty soon after that they'll change the laws to enable that to be normal. If you look in the next, I think the 2027 or 28, the EU will issue their own central bank digital currency. So once you have digital currencies officially from governments being issued, once you have sovereign bonds being issued on chain, there'll be then the momentum will get faster. And so while we're in initial slow start right now, once that momentum goes, then everything will go on chain. Oddly enough, I think the US is probably going to be the brake or the part that slows this process down, because, as an example, just late last year, the US Securities and Exchange Commission allowed the DTCC to run a pilot to issue tokens for securities, which is shares, equities, which is shares. But that's to trial tokenization. But that's not to issue the shares on chain. That'll be the next step after that. So they'll probably, allow tokenization of shares first after the trial, which will go. It's meant to start late this year and go into next year. Once they finish the trial, then they'll move on to that, and for a few years there'll be tokenized share trading, etc. For a while. Then eventually the rest of the world moves more on chain, and eventually the US will move that next step. But so I think by 2030, tokens will probably have a limited lifespan.
So it means people dumping those tokens losing value eventually?
I don't think they'll lose value because what they represent doesn't lose value.
They're still there. Yes.
The asset doesn't disappear. But what will happen is maybe the tokens will be replaced by reissuing those assets on chain or something like that. What I'm trying to say is by 2030, I don't see a demand for new tokens. It doesn't mean they just disappear or lose value because the underlying asset hasn't changed. It's just that as a financial product, I don't think after 2030 there'll be demand to issue new ones. That's all.
Wow.
So what I mean is there's a lot of
that is a very new insight. Very new insight to me.
If you look on LinkedIn as an example, there's a lot of companies now saying that they're tokenization service providers. They'll tokenize your assets. They'll tokenize your property. They'll do all these things for you. You'll see plenty of companies doing that.
Yeah.
And fair enough, it's a new and growing area. But those are not long-term businesses. They might be around for 5 or 7 years, but I don't see them being long-term businesses because I don't think there will be demand for tokenization much past 2030. Not like I said, not that the tokens will disappear, but there won't be a requirement for it.
But property that will need to be tokenized and are not yet on blockchain, they will still need tokenization because not all property will be tokenized in the next 2, 3, 4, 5 years.
No, property doesn't have to be tokenized to be on chain. What happens is if the land registry decides that they'll convert all the land titles to be on chain. That's all. Then it's all required. If that happens, you don't need a token.
Or it is the government system that decides to run everything on chain, not individuals.
So what I'm trying to say is, as an example, if you have land title that's already issued on chain, and Dubai has done this, by the way. If you have land title, now Dubai, I'll rephrase that. Dubai has allowed the land registry to issue land title on chain. It doesn't mean all land title is on chain, but a developer of a new land or new whatever can ask for that title to be on chain. Now, if that property is on chain, and they've also changed the laws that it recognizes fractional ownership. So you don't need to issue tokens when the property is already on chain and able to be fractionalized. You see, so tokens only have a use when there is no on-chain version of the asset. So, but when the assets start becoming native on the blockchain, like they're issued immediately onto the blockchain, There's no
Yes.
need. See, a token is a digital representation. But if the asset is already a digital asset, you don't need a representation of something that's already digital. Does that make sense?
Yes. Yes, it
So,
does.
so as an example, if right now, if you want to have Tesla share or an Apple share or whatever on chain, you can't. You have to have an SPV that buys the shares and then sells the tokens on chain. The shares are never on chain, but the tokens are, and the tokens represent the share. They're a digital representation. But if the Securities and Exchange Commission in the US said, okay, legally, a company can issue its shares directly on chain, then you don't need it. Then you don't need a token, because the
You
token is a
buy
digital
shares
representation directly on chain, because it's already digital.
Wow, I'm trying to digest this all information. I think I will digest it easily when I'm listening to the podcast.
So
Wow, that's
just the fundamental thing to understand is, what is a token? A token is a digital representation of something that's off chain. I'll take this a step further. I hope it doesn't cause further confusion, but stable coins are really tokens. And a stable coin is a digital representation of, USDT. It's a digital representation of US dollars, as an example. But
yes.
if the US dollar was a digital currency in the first place, you don't need stable coin based on, because it's already digital.
Yes.
It's already on chain. So there's no point having a stable coin.
Representing it.
There's no need to represent the dollar on chain if it's already issued on chain, if it's already a digital currency.
Yes. So in future, we shall have property on chain, not needing tokens to represent them.
To do that, all that has to happen is governments have to decide to enable that. So Dubai and the Kingdom of Saudi Arabia were the first in the world to enable that. So in every other country, like as an example, England or the UK has digital land title certificates, but they're not on the blockchain. They're just a digital certificate.
Yes.
But they're not on the blockchain, so it doesn't really help. And a few other countries have digital certificates. I think Australia does. And a few states in America have digital certificates, but they're not on chain. And again, the US, because of the way it's set up, they have 3,000, I think off the top of my head, 3,200 land registries on a county basis. So it's not national, it's not state, it's below state. It's sub-state, like counties within the state. So that's a lot of land registries. So for all of them to decide to go to issue land title on chain will take quite a lot of work. So the US will probably be one of the slower implementers. But in other countries where the land title system is a national system, like in the UK, like in the UAE, then, or at least on a state system, it'll be quicker and easier to implement. But it's when the governments decide to allow the regulations to allow on-chain land title, allow on-chain, shares to be issued, then that's when the big changes will happen. That's when all the stuff people talk about, the benefits of digital assets, will be most visible and available, is when those regulatory changes happen. But by that time, tokens won't be important.
But for now, we are going to enjoy using and owning those tokens.
Well, for now, it's a product that, it's a step between the old system and the new system. It's a way
Yes.
of bringing the old system onto the new system, but it's a temporary measure.
Wow, that's amazing, and I'm happy to be here now in the shift.
Oh, it's always fun. It's always fun to be involved in change.
Wow. Thank you so much. It has been a very, very great insight. I think we are going to end today's podcast. And thank you guys for listening from wherever you listen from. We are available at all audio streaming platform. My name is Daniel Leinhardt, and I've been having a great conversation with Mr. Reeves Knyght. Thank you for the great insight. Bye for now.
Thank you. Thank you for having me. Bye.